Hello, everyone, and welcome to another episode. We're live with Peaks Money Talk, and of course, we discuss topics related to your investments. Today's topic is CPP. That would be the Canada Pension Plan. All right, so today's topic is the CPP Canada Pension Plan. You may have heard of it, you may not know a lot about it. So let's go right to the gentleman, Lloyd, Nathan. What exactly is a Canada Pension Plan?
It's a retirement pension which is paid monthly, and it's a taxable benefit, replaces part of your income that you've paid all your employment life through. And you qualify it, receiving it the rest of your life. So it's one of those things that, being a Canadian, this is what you get.
Okay, so it pays to be a Canadian. Now, if I work for someone and I have is this your pension?
It's the Canadian pension, which the employer automatically has to pay a certain amount, and you have to pay a certain amount into it. So
it's almost like an RSP that the government puts on.
Okay,
that actually controls and for your retirement. So
your employer is paying this.
And
yes.
And you have to pay too.
Yes.
Right, it comes off your paycheck.
And it's tax deductible.
Okay, so these are all points too. And the other point I wanted to mention here as well was, what if I'm self-employed?
Then you have to pay both sides of it. So you have to pay a lot more, and the rate is very high, and you got no choice, you have to pay it.
So if I'm self-employed, is there a way to get around that?
Move from Canada.
But I was thinking, is there a way to change your tax bracket?
No,
or if you're
no,
if you're self-employed, you're paying from the company end, but you're also paying on your own end as well.
Yeah.
Right? But it's not like you can avoid that in any way, shape, or form.
It's mandatory.
It's like,
it goes in with your taxes on your CRA.
Okay.
Yeah, your quarterly installments are a form of that, paying into.
Okay, and if I have employees, then obviously I'm paying that for them as well.
Exactly right.
It's all part of it.
Yep. Yeah.
Okay, so that's on the flip side, but no matter if I'm working for someone or I work for myself, it applies to everyone.
Right.
That's right.
Right? Yeah. Okay, so I guess to answer my own question, I was going to say, how do I qualify for CPP? But I guess if you're a Canadian and you have a job, and you're over 18? Yep. I don't know, what else do I have to add to this?
Well,
I'm not sure.
If you qualify by being, to get the pension back out, you have to be at least 60.
Okay, so you can't dip early.
No, not before 60.
Okay.
And made at least one contribution to CPP. Like sometimes people have maybe never worked all their life. Okay,
because I was trying to think in my head of how would you have not made a contribution to CPP if you're doing this?
If you've never worked.
Yeah.
Okay, so if you've never, so how do you get around that if you've never had a job? Like maybe you're a homemaker and you've been raising the kids your whole entire life, which is a job in and of itself. Let's just qualify that. But you haven't paid into CPP. How do you do that?
Well,
you get a financial advisor, and they help you with this.
You can't do anything about that unless you try and get some of your husbands, because you can, if you've been together long enough, split it. Even though.
Can you split it? Yeah. You can do that?
Right.
Okay, so that's an option.
Yeah, and then with CPP, you get into a lot of different little segments that may crop up. Like, say for instance you worked when you were younger, and everybody likely did, you would have contributed in there. And then when you have your children, it's considered time off, okay? So you would get, it wouldn't count against your time that you've, total amount of time. Also, they reduce 8 of your years, your best 8, your worst 8 years they take off. So your total always works higher.
Oh, okay. So I like that, but it's your worst 8 years, not your best 8 years. Yeah. I like the sounds of that. That's even better. So then how do I start? You said number one, how old do you have to be?
60.
At least 60. So none of this freedom 55 stuff here for this.
Not for CPP. Anyway.
Not for CPP.
Not for CPP. It's at a reduced rate at 60.
Okay.
And
reduced rate. What does that mean?
That when they give you the amount that you're being paid, it's based on 65.
Okay.
And so they deduct 36%.
Okay.
So that when you receive it at 60. And the ongoing saga that you'll always hear is, do I take it at 60? Do I take it at 65? Or do I not take it till 70?
Well, I was just going to ask you that question. So you just, okay.
There's no two situations the same, because here you are, you got people that, okay, they retire at age 60. They might as well start taking it as a rule. They're working till age 70. Don't take it. You know, that's why you have to sit down and go over all the parameters that's available to you, like how much money they got, how much income, where their other sources are they still working, where are their children in this life? You know, there's all those questions that you ask, so that when you make a decision when to take your CPP is based on all the decision and that's available, and or the information, that's available, and everybody's different. You hear everybody say, you got to take it at 60.
So when you say like to take it at 60 or 65 or 70, whatever it is, what's right for you, when you are taking this and I am withdrawing the money from that, I have paid into this my whole life. Am I paying tax on this?
Yes.
As it's coming out?
It's like an RRSP.
Okay,
Yeah.
okay. This isn't because I just want to clarify, because it's not like I'm just going to the bank and getting free money and you do so. I have paid into this. Your employers have paid into this, or self-employed, you're paying into. But as you're taking it out, I guess because you received a tax break on it?
Yes, because it was tax deductible.
It was tax deductible.
When it came off your paycheck.
Yeah.
You mentioned that earlier, Nathan. Okay, so it's tax. So now I'm going to use it, and now I'm going to pay the tax on it.
Yep.
Right.
Okay, and is there a way to get around a lower tax bracket on this, or is it determined on how much you take out and then how much you're making? Which is what, to your point, maybe you're looking at, maybe I have a part-time job, I'm making this much money, and I'm going to supplement it with this. Does that make sense?
That's exactly what happens.
Okay.
So too many people just say, I want it, because it's a government, it's a handout.
Okay.
Well, you got to figure out how it's the most feasible to you to pay the least amount of tax and still have the best income you could.
Right. Well, and taking it early, the one issue with that is, once say you take it at 60 and that percentage is taken off, that's how much you will get for the remainder of your life. But if you hold it till 70, it'll be indexed and you'll actually make a little bit more than if you took it out at 65, but that's what you'll be getting for the rest of your life.
So again, you're kind of wavering with the odds of, if you wait, you benefit more, you stand to gain more. However,
but you lose out on those years that you could have received it, but you didn't. So depends on how long you live. If you live to 100, it's probably better to pull it out probably at age 70. But if you only live to 85 or 80, it might be better to take it out at 65 or 60.
Okay, so if you are, so to your note too, if you're looking back and you're thinking like, what's right for me, I guess you have to figure out, right? And know what you're making and what you need and those sorts. And that's where you talk to your financial advisor. Now, to your point, Nathan, if I'm waiting longer to take it out and let's say something happens, what happens if God forbid there's an accident, and then what happens to that CPP? Does it disappear because I'm no longer here, or do I get to transfer it to somebody?
Yes, you have called a survivor benefit.
Okay. Is this something I would sign ahead of time? Or
no, it's automatic.
It's automatic.
Oh, okay.
And it goes to your husband or your common law spouse.
Okay.
And but the problem with that is that you can only get to the maximum amount that you would normally get. Whatever the amount is, 1,100 and something. So if your survivor benefit and his payment is more than that, you don't get it. Like, you get cut back. So it's based on what the total amount would be, and it cannot exceed what you would get at age 65.
Right.
So that's one of the problems. But nobody wants to do the morbid say, oh, you're going to die. So
Right. And just to go back for a second too, if we're looking at like, how much can you take out, or how much can you get? Like, is it up to you?
Well, it's up to the government. They have it prorated at how much you're getting back out all the time. And the rate is based on how many years you've worked and what your work, how much your salary was at that time. And so that's what their basis of where they come up with for the amount that you're going to get at age 65.
Okay, so it's different for everyone.
Yes.
Right.
Oh yeah.
Okay. It's not like a baby bonus, and here's what you get. You're in a certain thing.
There's a max. But there's no, like I said, for figuring out for a person or a couple, there's no cut and dry thing.
Well, I find that with anything, right?
Different.
I think that's why you really want to have a strong relationship with your financial advisor, because they really do need to know you and what you are all about and need and do and how you live your life. You know, at the end of the day, if we're talking about CPP or whatever the case may be, you'll know better. You'll be able to.
They can make you so much money and save you so much tax that a lot of people think that, okay, they don't do anything for you. Okay, I just went in and signed something. But really, they're thinking about ways that you don't have to pay as much tax and you get more income. So that's the basis of what you're trying to do from an advisor, is get the best you can from him. And he will do the best for you, or she will.
And then, and to that tune, I'm always like, how you can live your best life, really,
Yep.
right?
Mm-hmm.
And do what you want to be doing while you're managing the investments.
That's right.
Okay, on a final note, is there anything else we should talk about benefits of CPP?
There's another thing that you should learn, and anytime somebody passes away, there's always, the mortician will always send in for, it's called CPP Death Benefit.
Oh, okay.
So there's always a death benefit that goes to your estate. Mm-hmm. And so, and it's $2,500. I think it is. They change all the time, so I would go on the basis of $2,500. But your mortician will help you with that and fill out the paperwork and send it in.
Okay, and then what am I doing with that?
And it goes to your estate and usually ends up paying his bill.
Okay, so it's something versus, okay.
Yeah.
That's always good to know as well. Anything else we should mention in terms of, I guess that is a benefit. I asked what the benefits were, and that is a benefit. Yeah, anything else we should add about CPP? I find each of our topics that we discuss on Peaks Money Talk, you know, the deeper we get, the more you'll learn, the more I learn, but the deeper we go and dive into each of these subjects.
There's always questions that will come up from them that we thought, so like on our way home tonight, we'll say, oh, I wish we had talked about that, or we had talked. So that's why feel free to get a hold of us and give us questions, because we can't hit everybody's topic.
But we'll try,
Yep.
right? And in future episodes. Anything else, Nathan, before we go?
No, I think he pretty much summed it all up. So.
All right. Okay. Well, we always rely on these two gentlemen for our investment information and details on Peaks Money Talk. If you have a question, as Lloyd mentioned, please do list it below, and don't forget to like our page and subscribe so you don't miss another episode, or so you continue to watching Peaks Money Talk. Thanks so much.